Joining me now is Lauren Seidel-Baker, speaker and economist at ITR Economics. Lauren, welcome to the show.
Thank you so much. Great to be here.
PCE data just dropped about 30 minutes ago. What is your biggest takeaway from the numbers?
So this was not enough of a surprise to really move the needle on market expectations. We knew that inflationary pressures were building. The Federal Reserve is very aware of these pressures. They're watching them very closely, but at least the more recent dovish messaging out of the Fed seems like they're more concerned about the labor market side of their dual mandate. So I think this does not take a 25 basis point cut off of the table for their September meeting, but we do get additional labor market data next week and some CPI numbers. Even though that's not their preferred inflation gauge, they will be watching that later in September.
All right, and looking ahead, what do you expect PCE data to tell us for the rest of the year? And do you think tariffs could play a role in driving inflation higher?
Tariffs are absolutely inflationary, but I don't think we're seeing that inflationary impact from tariffs quite yet. Our analysis here at ITR Economics suggests that it takes between 9 and 18 months for tariffs typically to flow through to affect final pricing. So tariffs are really good at hitting the microeconomic level. That is, if we put a tariff on, say, steel, then all steel imports will see that higher price. But on a macroeconomic level, there are so many other things in the mix, especially things like shelter costs that just don't move as rapidly with a tariff imposition. So I don't think we've seen that full tariff effect take hold yet. That's not what's driving today's higher level of inflation. Today, we're faced with just more fundamental factors. Previous fiscal and monetary policy. We have wage pressures in there. We have rising energy costs in there. There are a lot of different kind of a broad range of things driving inflation higher. So that's something the Fed will have to watch for and that businesses really need to be aware of.
You said the labor market is in balance, but with both hiring and job-seeking activity low, can you unpack for us what that means?
Absolutely. So the other side of the Fed's dual mandate, if not stable pricing, is full employment. And they have a way to define that. But really how I prefer to look at the labor market, it's not through an unemployment rate per se, but I prefer to view the balance between job seekers and open positions. For a while, back in 2022 and 2023, that was a 2-to-1 ratio. There were 2 open jobs for every 1 worker. Today, we're hovering right around that 1-to-1 ratio, but the levels are just lower. So when we look at something like the jobs report, say, that comes out next Friday, that shows the number of new jobs created. Today, the real limiting factor is labor availability. We have demographic trends that are turning down in terms of just the numbers of job seekers out there. Businesses, on the other hand, are also pulling back a little bit. There's so much uncertainty. They're not rushing out with those job postings, those help wanted ads. They're waiting to just be sure, where does this policy uncertainty play out? Where do tariffs play out? So I think we can still have a labor market balance, but just with lower levels on both sides of that scale.
Lauren, what's your outlook for the Fed's September meeting? And if this inflation does pick up as expected, do you think the Fed's ability to cut rates could further be limited?
I think it could be limited, but only later in this year. I think 25 basis points in September. Maybe we get another, 50 basis points of total cuts in the second half of this year. I don't think that's going to move the needle too much. Obviously, for very interest rate sensitive sectors, there will be a little bit more reaction. But for the general macro economy, 50 basis points, even let's go crazy, let's say 75 basis points, that isn't going to be the thing that flips the switch on new consumption or on new business investment. So I would say 25 basis points seems pretty baked in. Today's PCE number was not enough to take that off the table. But going further, if we do see this inflation a little bit stickier, even today's core PCE number, 2.9%, that's not close to the 2% target that the Fed has outlined.
And we received fresh GDP data yesterday showing continued growth. How do you think that fits into the bigger economic picture right now?
Overall, we still do see growth. So ITR Economics is not forecasting a recession. We think the consumer is the backbone to the economy throughout this growth cycle. Now, that said, all of this consumer strength, it's really predicated on those rising wages. Today, wages are still rising at a faster pace than inflation. So that's giving our consumer the ability to go out and spend. And about 2/3 of GDP does come down to consumer spending. So going forward, the consumer is that stable base that this growth will be built on. But I don't expect the growth to really take off as it did last business cycle. We're going to see more tepid growth rates, still positive, but maybe not anything to write home about.
Lauren, what else should viewers know about the Fed, the economy, inflation right now?
I think it's the interworkings between those few things. I am much more focused on inflation than I am the job side of things. I think that's going to be the bigger pressure. So for businesses, for investors, you really need to watch those margins. The top line can be doing great things in an environment like this, but you need to watch the margins to be sure the bottom line is there too.
Thank you, Lauren Seidel-Baker, speaker and economist at ITR Economics. Coming up, NY